Welcome back, everyone. Today, we're diving into a literal masterclass in defying market volatility. We're breaking down iFAST Corporation's unaudited first quarter 2026 financial statements. Now, if you're a dividend growth investor hunting for sustainable, accelerating value, well, you are absolutely in the right place. We're going way beyond the standard press releases today to see exactly how their massive global expansion and record $32.64 billion in assets under administration are translating directly into cold, hard cash flows. Let's get into it.
Look at this number right out of the gate, 47.5%. That is iFAST's year-over-year profit jump for Q1 2026. Almost 50% growth in pure profit in just 12 months. When a financial institution scales at this kind of blistering pace, it's a massive signal. It tells us they are aggressively tracking right toward their North Star goal of hitting $100 billion in AUA by 2030.
So here's our roadmap for this explainer. 1. The big Q1 headlines. 2. Unpacking revenue and profit. 3. Boom in banking operations. 4. Strategic capital and debt. And 5. The shareholder impact. Let's dive right in. Starting with Section 1. The big Q1 headlines. Bottom line up front. Okay, check out the absolute profit for the period here. Back in Q1 2025, they were sitting at $18.99 million. Fast forward to Q1 2026, that number leaps to $28.03 million. And for all of you dividend growth investors closely tracking the bottom line, basic earnings per share moved from 6.37 cents straight up to 9.20 cents. That's a 44.4% increase. And really, this is the exact foundational metric that underpins their incredibly ambitious 25% strategic dividend growth proposal. Moving right along to Section 2, Unpacking Revenue and Profit, the top-line surge.
Now, you really can't fake top-line growth, right? Core revenue absolutely skyrocketed by 49.4%, hitting $136.8 million. And this is being driven by that record-breaking AUA of $32.64 billion we just mentioned. A massive engine behind all this momentum is the Hong Kong e-pension project. It's rapidly transformed into a highly predictable, recurring revenue powerhouse for them. And notice how tightly that 44.5% total revenue growth mirrors the 47.5% profit growth. It's just a beautiful correlation.
Looking a bit further down the income statement at the results from operating activities, we see a 43.7% increase, taking it to $34.19 million. But you might notice staff costs actually jumped 83.1%. Now, don't panic. While they are actively absorbing these hiring costs to scale up their operations right now, management has been crystal clear about their future playbook. They're calling it the death of the linear growth model. Moving forward, they plan to lean heavily into AI-driven margin expansion. The goal? Completely decouple revenue growth from headcount. It's a real game changer. All right, let's hit Section 3, Boom in Banking Operations, the deposit ramp-up. Digging into the financial notes, customer deposits within their banking operations surged 40% year over year. They hit a massive 1.613 billion Singapore dollars. Think about that scale for a second. This isn't just a simple investment platform anymore. They are actively building a formidable moat through global transactional hubs in Singapore, Hong Kong, and London. They're creating a deeply entrenched, sticky banking ecosystem. So, this quote, pulled directly from their financials, is absolutely key to understanding one very specific line item. Their banking interest expenses actually grew by 13.1%, hitting over $11.1 million. Now, normally, seeing rising expenses is a major red flag, right? But here, it's the direct result of that continued ramp-up of customer deposits. Paying more interest simply means you're holding substantially more of your customers' cash. It's literally the cost of successfully attracting a massive influx of capital that they can then turn around and leverage across their entire broader business.
Let's pivot to Section 4, Strategic Capital and Debt, Funding the Future.
This timeline is honestly a masterclass in corporate finance. Back in June 2024, they issued their first major note, $100 million at a fixed rate of 4.238%. But look at what they just executed this quarter. On March 3, 2026, they issued a second note, this time for $120 million, and they locked in a dramatically lower fixed rate of just 2.75% per annum, due in 2031. They are systematically diversifying their funding sources away from just relying on equity and bank loans. And they're doing it while significantly lowering their overall cost of capital. Locking in a fixed 2.75% rate for 5 years in this kind of economic environment, that gives them incredible operational leverage. You can see the direct result of this strategy right here under unsecured debts. It more than doubled from 99.2 million at the end of December 2025, straight up to 218.6 million by the end of March 2026. That jump, that is the new $120 million note fortifying our non-current liabilities. And if we track the cash flows from financing activities, there is the $119.29 million in net proceeds from that exact debt issuance flowing straight into the business war chest. Even after making operational investments and paying down bank loans, their cash reserves are sitting at a staggering $620 million. For a dividend growth investor, this immense liquidity represents unparalleled safety and flexibility. It's exactly what you want to see.
Finally, Section 5, the shareholder impact, value creation.
So what does this all mean for you? It translates into undeniable mathematical value creation. Taking basic earnings per share from 6.37 cents straight to 9.20 cents proves that this aggressive expansion isn't just some vanity metric. That 40% boom in banking deposits and the highly efficient 2.75% debt restructuring, it all flows directly to the bottom line. This is the exact fundamental performance that gives management the confidence to propose that 25% strategic dividend growth trajectory.
As we wrap up this explainer, I really want you to consider the evidence we've just unpacked. We've seen a 47% profit surge, a $1.6 billion deposit ramp up, and a rapidly expanding global moat. With incredibly cheap capital locked in and AI-driven margins on the horizon, how will iFAST deploy this capital next? Given their sheer agility and the seamless integration of investment and transaction banking, we really have to ask the big question: is the traditional local banking model becoming a relic of the past? Thanks so much for joining me today, and keep learning.